Happy New Year, everyone. As the year gets started, the big question is what's in store for investors in 2023? Everyone wants predictions. But this year, the crystal ball is even more cloudy than normal. Basically, I'm playing a guessing game with the Fed. That said, I'll share some insights into what I'm seeing and how that could play into the Fed decision on what to do with interest rates and what will happen with commercial real estate borrowing costs. I'll start with the inflation readings, which is the root of the whole thing. Basically, they're all showing a downward trend, but they're also all still too high. The consumer price index peaked at 9% last June, and the last reading was 7.1% in November. A lot of that drop came from oil and gas prices coming back down. Core CPI, which doesn't include gas, peaked last September at 6.7% and has since come down to 6%. Core personal consumption expenditures, or core PCE, which is the measure most closely watched by the Federal Reserve, peaked in March at 5.4% and has since come down to 4.7% as of November. These are all really backward-looking indicators. They're all from November and they're in the rearview mirror. Now I'll focus on fresher insights that give a good indication of where we are now. The cost to ship a container full of goods from China to the United States has come way down. It peaked at $19,200 in September 2021, but has since come down to $1,400, basically back where it was before the pandemic. In addition, container traffic to the ports of LA and Long Beach have begun to slacken as retailers backed off on their overseas product orders. Basically, retailers have stockpiled sufficient inventory in local warehouses to meet their expected demand levels, and they think supply chains are safer now. We're also seeing commodity prices come back down to earth. The price of lumber is basically the same as it was in 2019 on average, and the price of steel has dropped in half from its peak in April last year, but it's still 20% higher than it was in 2019. Circling back to my key point, supply chains are finally getting back to normal, and that will help roll back inflation. Finally, there's the ISM Manufacturing Index that's been declining since May of 2021. The December reading came in at 48.4. Because that's below 50, it means that manufacturing demand is shrinking. Again, that suggests the economy is slowing down and inflation should go with it. Basically, a lot of the forward-looking indicators suggest that inflation is pulling back. But not all of them. The labor market is still strong. We still have 10.5 million job openings. That's down from nearly 12 million openings in March last year, but it's still twice the historical average. And the unemployment rate is still just 3.7%. Net-net, it looks like inflation will continue to recede. The question will be whether the Fed also sees that trend and whether they think it's going to come down fast enough. That will culminate in a decision on February 1st that will have significant implications for the commercial real estate market. A decision on whether to increase the federal funds rate by 25 basis points or by 50 basis points. Right now, Wall Street thinks there's about a 60% chance of a 25 basis point increase. If the Fed goes with 50, it signals that they think they still need to push to contain inflation. That would be a disappointment for Wall Street, and it would likely keep commercial real estate lending rates elevated at least until the Fed's next meeting on March 22nd. If the Fed goes with a 25 basis point increase, it would signal that the Fed is easing back and will likely take some time to let the dust settle. In that case, lenders may pull back their spreads a bit, commercial real estate investors will accelerate the price discovery process, the buyer and seller expectation gap could begin to narrow, and the market will begin to normalize. So, what the Fed does on February 1st will have a big effect on the commercial real estate market. But as always, investors need to watch for opportunities in the current choppy market and always keep their eyes on the horizon.